Okay, everybody, it's me, Gregory Mannarino. It is Monday, May 30th, 2022. This is my newest segment of Markets A Look Ahead. This is a big week with regard to this market. The action we have seen as of late, well, as I said, if a few things fall into place here, and we'll cover it again now, this market is going much, much higher. So just get ready for that. I want all of you to be on the right side of this. You know my take on this from the get-go. I have been saying since this whole route started, January-ish, somewhere around mid-January, I said this is just a normal corrective phase. Keep in mind, although the NASDAQ, yes, is in a bear market, the S&P 500 is not. We have never fallen below 20% off the high, which would be by definition a bear market. S&P 500 is the broader market. That's what you should be focusing on. Forget the Dow Jones Industrial Average. It's 30 companies. And even with the Dow Jones Industrial Average, we are not in a bear market. But I understand all the fear, all the nonsense that's being pushed down your throat. I am certain I'm not the only guy. Many of you watch out here on YouTube, and there's, the crash callers every freaking month for years. And they've been all wrong. Imagine my shock there. Anyway, that's a whole other thing, I guess. Anyway, I said what I had to say on Friday when I called these people out. They're a bunch of idiots, basically. And, look, if you're wrong 100% of the time, it's time to change your tune, maybe. Anyway, that's again, a whole other thing, which I covered on Friday. So, with this market, people, again, let's step back and let's focus on what is happening and what needs to continue to happen. Number one, you know what the key to the market is. One key and one key only. That is the 10-year yield, which is the benchmark, which is going to tell you and I where cash is moving through this market. There's also a lot of capital inflows into this market, institutional cash moving into the stock market on top of a tremendous hoard of cash, which is now in the debt market, seeking safety. Once that starts to move out of the debt market, and you will see this with the 10-year yield rising, again, in a controlled manner. If we see a big sell-off in the debt market, that is a very negative sign. Right now, the 10-year yield stands at just about 2.5, just about there. That's where we started and ended on Friday with regard to the 10-year yield, 2.5%, okay? And yet, even still, nice gain here with the stock market. That's institutional cash coming into the market, looking to get in on what appears to me a market that's massively, massively oversold. And more specifically, the financial sector, the banks, gotten pummeled. In my view, and it looks like in Wall Street's view, there are deals to be made, which I've been telling you for the longest time. The tech sector needs to play as well. Three need to happen really for this market to make meaningful gains moving forward. That is, number one, 10-year yield either needs to stay where it is, or better yet, move up in a controlled fashion. Slow and easy, slow and easy. You got it? You know where I'm going with that? Okay. Slow and easy. Very, very nice. If that 10-year yield does move higher, that's cash leaving the debt market, looking for a place to go. You all know that. You're all experts on this. If crude oil continues to get bid higher, WTI right now is $117 a barrel. Okay. This is obviously, can I get a duh, please? Okay. Crude oil, lifeblood of the military-industrial complex. The market loves crude oil getting bid higher. This will boost the entire energy sector. This will boost the financial sector. Who finances all this? It's the banks. These investment banks are, again, I will tell you, it should be obvious, have such, I don't even know how to put this, leveraged bets on crude being high and staying high, that when crude goes higher, it lifts the financial sector as well, obviously, as the energy sector. Make sense to you? Okay. If that continues, that's going to put a lot of boost under this market. Now, tech has gotten destroyed, absolutely pummeled as of late. Not all of it. I mean, some tech stocks have done very well, IBM being one of them, a position I have, something that's been posted on my website, traderschoice.net, for months. And if you've got in on that, you've done very, very well. If you've got in on oil and gas producers, ExxonMobil, ticker XOM, ticker CVX, DVN, to say the least, you've literally ripped the face off of this market. Yes, banks have gotten destroyed, but I'm not selling. I'm going to be adding to my positions. PDBC, the exchange traded fund that would give you exposure to commodities. This thing has done phenomenal as well. Again, all this stuff I've disclosed here on this blog. I've sent this out in my newsletter here. Some consumer staples as well doing very well. Coca-Cola, Altria Group, all on my website for you. Again, link down here in the description of this video. Take advantage of these things. So let's move forward here. Okay, so we need a few things to fall into place. I just covered them. 10-year yield moving higher in a controlled manner. We need the financials and, well, crude oil to play as well, tech sector to play. And this market's going to go up very, very rapidly. It looks to me, again, gauging from the inflow of capital by institutions, that they're buying. Imagine Greg Mannarino's shock here. There's nothing going on in the debt market that is sounding any kind of alarm. There are no red flags. As a matter of fact, the MMRI, Mannarino Market Risk Indicator, is now yellow. It's back yellow. And I've been urging you to learn how to use the MMRI, which is not a crash indicator, my lovely friends. No, 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 no. This is just measures risk based on what is happening in the debt market. The debt market is the driver. You know that. It's the biggest, massive, most hideous, vomitous, disgusting bubble in the history of the world. And every single crisis after crisis after crisis that comes along here that is just magically created out of thin air, they all must be funded. Where does that cash come from? We don't have it. No, we don't have it. It has to come from the Federal Reserve. I'm pointing at my hat. Public enemy. Can you see that? Number freaking one. All right, let us move forward here. So we've seen the, how do I put this again? I can't say relative strength of the dollar because people don't understand it. The comparative strength of the dollar come down as of late a little bit. This is also positive for the stock market. Looking at the Dixie, okay, DXY. Gold and silver had quite a ride recently. Again, it's a rigged game. If you're not holding the physical asset, I think you're on the losing side of this. You need to understand what you're doing, why you're holding this stuff. You're betting against the debt. You're becoming your own central bank, holding real pieces of wealth, people. That's you understand that. With regard to cryptocurrencies, people, we have been stuck in a range for quite a while. Bitcoin bouncing between just over 30,000 to just under 29. I mean, we're kind of doing this now for quite a long time, and we'll see how that goes. You know my take on cryptocurrencies as well. I don't trade this stuff. I hold it because I sincerely believe this, and I think a lot of you understand why I like cryptocurrency. And also, with regard to precious metals, it falls into the same category with regard to where I believe cash is going to move once it really starts coming out of the debt market. The debt market implosion is really where I am positioning myself, okay? And that's why I am in both risk on and risk off assets at the same time. Why I advocate for that. Be in the market here. For the most part, own large capitalization companies that are going to pay you to own the stock. You understand? Via a dividend here. And going back to that, I had alluded to, I think it was on Friday, saying, shareholders of these banks have not been very happy lately. I'm a pretty big shareholder of 3 major banks. And, what's going to happen here? Well, they're going to listen to their shareholders. They're going to either do what? Number one, they're going to institute some kind of a stock buyback program if they need to, and or raise a dividend. So I want both of those things. I mean, wouldn't you? Pretty straightforward here, people. So that's the setup right now. You know what the keys are to this market. Watch them. Keep your eyes on that 10-year yield. Let's see where it goes. Like I said, we're at 2.5 right now, 2.5%. It's going to be interesting to see where that goes. In my opinion, once we settle above 3% in this environment, again, nothing is static. You have to realize everything is fluid. And the fact is, the Federal Reserve is raising the federal funds rate. They're still pushing the dog shit fake narrative that by raising that federal funds rate, they're going to be fighting inflation. No, they're actually continuing to create inflation by doing what they are doing, keeping the actual rate below neutral. I mean, think about that. They say, oh yeah, we're going to get really serious about inflation. We're going to be rising the benchmark rate above neutral. Duh. Really? Well, how about doing it now? Because if they don't do that, all it's doing is creating more inflation. Oh yeah, but hold on a minute. The Congressional Budget Office, the Congressional Retard Office, they're saying, inflation is peaking. It's all going to get better by now. But as we just found out last week, inflation continues to surge even higher. I'm stunned and I am shocked. All right, people, look, you know the story. You know what's going on. Keep your eye on the 10-year yield. Learn how to use the MMRI, Mannarino Market Risk Indicator. Again, link in the description of this video. Free to anyone who wants to look at it. If you don't want to look at it, that's fine. Okay, it's right underneath the chat room. So if you happen to click on that link, scroll down. Actually, no, hold on a minute. I'm wrong. The MMRI is at the top of the page. I moved it. So once you click on that link, it's right at the top of the page. If you do scroll down, you'll see my chat room, my most recent stock picks. Pay attention to these things. I'm trying to help you. I really, really am. Watch WTI crude or crude oil in general. You know how the market likes that. Watch the comparative strength of the dollar. The market likes that weak. Let's see what happens this week with regard to the energy sector. Is it going to get bid up? Is the financial sector going to catch a bid? Banks? Is tech going to catch a bid? I mean, this is the keys here. If these things fall into place and it looks like they all want to play together, they want to play nice. This market is going to put on some nice gains. Let's just see. We got it covered no matter what happens. Again, we are in risk off and risk on assets. Risk off precious metals. In my view, cryptocurrencies to a certain degree fit into that as well because, again, when the debt market implodes, cash is going to move into that, in my opinion. It's going to move in like a tsunami. That's the word I've been using, into commodities, not just gold and silver. Commodities in general are going to balloon. Okay. And I think, again, the market cap of cryptocurrency is also going to balloon along with that. So I hope this makes sense to you. You know what to do. You know what to look at. There's no guesswork here. We're watching the flow of cash through the market, okay? Understanding the 10-year yield is the key. If the 10-year yield comes up, that means cash is leaving the debt market. It's going to look for some place to go. In my view, it's going to make its way directly into the stock market, especially because we have a large amount of institutional cash being pushed into this market. You understand? I hope you see where this goes. I will see all of you in the morning. I'm looking forward to that. We got this. We got each other's back, and I love it. I'm out of here. I will see you in the morning.